Hello and welcome to this update after the second quarter. Before I start, let me all wish you a very happy Durga Puja, Dasera, Navratri, and wish you and your family a very prosperous festive season. Uh, I thought that giving in addition to the investor letter that I write, uh, a very short video update might be more useful because when I see people around me, I think we are all now getting more used to watching videos uh, on YouTube or as reels or things like that than reading. Although personally I prefer reading and writing, but I think more and more people are getting more comfortable with the video medium. So I thought, let me try this as an example, and depending on the feedback that I get from you all, we will continue doing this from next quarter onwards. So first of all, let's look at the performance that we've had. Uh, the first half, so from 1st of April to the end of September, both Lakshmi and Vriddhi have done slightly better than the benchmark, which is BSE 500. Uh, as you know, last year we did quite well, significantly outperforming the benchmark. And overall, since inception, for those of you who've been with us since we started in May of 2022, the performance and the going has been fairly smooth. Now, having said that, the point that I keep repeating often is that markets are volatile. They don't go up or they don't go down in a linear fashion. So it doesn't happen that markets will continuously go up or continuously go down. There is going to be volatility. There are times when the volatility increases and there are times when that volatility decreases. We are now going through a phase where the volatility is significantly high, and that comes after a fairly long run of extremely good performance at the market level. So last 1.5 years or 1 year has been very good for the markets, and so when I say very good, anything where returns are above 25% at the market level, I consider very good, because that is far beyond the norm of Indian markets. Indian markets on an average grows roughly between 12 to 15%. The last 2 months of previous quarter, when you see, we saw that the overall market cap has actually fallen by 2%, right? And when I say that it is above the overall market cap, I mean all the stocks. So roughly 2,500 stocks in the NSE. If I put all of them together, they've fallen by 2%. Whereas the overall, broader indices like Nifty and Sensex have actually posted 2% higher gains. So what it means essentially is that the market at just below the top of the market is going through a period of consolidation and decline, and the decline has been fairly broad based. All the sectors that have performed well previously, whether it is railways, whether it is defense, whether it is PSUs, energy, everything has corrected and has gone sideways. So that is one interesting point about the market. Personally, I feel the kind of investments that we follow, both in Lakshmi and Vriddhi, we have no relation to any index. We do have a benchmark, which is BSE 500, and the reason we have a benchmark is because we are bound to have a benchmark. Without a benchmark, we are not allowed to operate. But the point is that we have no correlation with any index, whether it is Nifty, Sensex, BSE 100, 200, 500. We have no correlation because the stocks we pick are not top down. So what happens in a mutual fund, and one of the reasons why I think personally that mutual funds tend to not perform well over time or not outperform over time is because mutual funds have a very close alignment with indexes. So a fund manager does not have the leeway to deviate from an index. So for example, if BFSI or if banking and financial sector is 40% on Nifty, and if you are running a large cap fund, as a fund manager, you will not be allowed to deviate plus minus say 5% from that. So you can have 35% to 45% of financials in your portfolio. Whether you like financials or not, you have to have that exposure. For us, we have no such obligation. We have no binding to any particular index, which over the long term gives us a lot more flexibility to be in stocks which we like. And people who've been with us for more than at least a year and a half, you will realize that we are very growth focused investors. And I keep repeating in all my public discourses that ultimately markets value growth. If there is no growth, markets will not give valuation to a company. So I am a person who looks for growth in a business first, and of course the fundamental quality of a business, the quality of management, and the duration that growth can sustain are very important inputs. So I think that in the next 2 to 3 years or maybe next 5 years, India is very well placed. I keep repeating this, that we are in a environment where we've become the fastest growing big economy in the world. A lot of structural tailwinds are there behind us. We are seeing a lot more of focus on development, and I'll talk about it a little bit in details now, later part of this discussion. So I think we are very well placed for the next 3 to 5 years. My hunch, and I of course reserve the right to be wrong, is that the next 10 years is going to give us the kind of money making opportunity that we Indians have never had before. So I am that bullish. Of course, does it mean that the next 10 years the market is going to only go upwards? Of course not. The markets will go sideways, it will fall, and we have to be prepared for that, but we have to be prepared for being there for the long haul. The other thing I want to touch about is suddenly we are seeing that there is a lot of uncertainty, lot of political trouble brewing all across the world. If you see Israel, Palestine, Iran, the whole Middle East has suddenly gone up in flames. Russia, Ukraine, already 2 years on, there seems to be no end to that. So there are continuous problems. African countries where the sustained problems continue. Sudan, Syria, the Democratic Republic of Congo, they've been in sort of some form of war for a number of years, and they are not in the limelight for various reasons. But the point is that very large parts of the world are now in a boil. US elections are coming up. We see a lot of elections happening in the Eurozone, different kinds of political formations coming to power or becoming more powerful, people or political parties which were not mainstream earlier. So we are going through a period of flux, and within that flux, if you see, India is standing like a beacon of hope. If you look at the fundamentals, our government and corporate balance sheets are fairly strong. Yesterday, I think the Reserve Bank, today I'm recording this on the 8th of October. Yesterday, Reserve Bank gold reserves, I think, crossed gold and foreign exchange reserves crossed 700 billion. So fundamentally, as a country, we are very in a very strong position. And globally, we are now getting into a declining interest rate regime. So not only the US Fed, but if you look around, the Swiss bank, the European Central Bank, Bank of England, Bank of Canada, everybody, Bank of Japan, everybody has reduced rates. So globally, we are in a rate reduction regime. And typically, unless you have a external shock, rate reduction is typically good for equity markets, especially emerging market equity markets. So I personally feel that the next few years could be extremely good for India. So that is the good part. Now let's come to the challenge that India has. Now the biggest challenge that we have in India, in my opinion, I mean, if I ask anybody out on the streets, I think as a country we are a set of people who are very quick to criticize. If I ask anybody what are the biggest challenges of India, I think anybody can give out 10 different reasons. We have problems everywhere you look. We have lack of infrastructure, our education system is poor, our healthcare system is poor. Pretty much anywhere you look, there is room for very large improvement. But within that, I think one of the biggest challenges that we as a nation face and the government faces is the lack of jobs. Because unless you are able to provide jobs to the large number of employment seeking youth, you are going to get into a major problem of socio-economic problem. And so globally also, the share of youth who are not in employment, in education or training, right? So people who are either working or studying to get employed, the ratio of that is very high in India. And it has gone, although it has gone down, right? In 2019 it used to be around 30%, 31%. Now it is 23.5%. But the fact is that 1 out of 4 youth in India are people who are not employed, right? And that is a very scary number to look at. This budget, though we saw a lot of initiatives being taken, we saw talks of direct cash transfer to new employees who are brought into a company. We saw a lot of discussion on internships, employment generation in manufacturing, different forms of financial support to employers by backfilling their EPFO and payments to employees, etc. But the fact is that we need to see this actually getting converted to real jobs. Just policies will not make a huge difference. It is a beginning, but we need to see it translate into job growth. And if we are able to get job growth, that would be a virtuous cycle. People getting jobs, getting salaries, would be able to spend, and that would lead to a much more robust and vibrant economy. Now, the other important point here is, if I look at emerging markets and countries that have done well at some point in time in the last 20-30 years, especially Asian countries, there was a very a phase of time, whether it was 5 years, 6 years, 10 years, 20 years, where GDP growth was extraordinarily high for a country, and that growth was typically led by manufacturing development and the share of manufacturing in their GDP going up significantly. So we saw Thailand from 1985 to 1991, going through a 9.3% GDP growth during this phase, where manufacturing share went from 21.9% to 28.2%. Similarly, China, I think, had the biggest boom, where manufacturing share went from 9% to 32% over a 15-year period from 1990 to 2005. And similarly, we have seen in Indonesia, we've seen in Vietnam. Now, India has just embarked on a policy of boosting manufacturing, and we start off at that 15% level. Can we repeat what Indonesia did? Right? So Indonesia went from 14 to 24%. So ideally, India is looking to go from 15 to 20%. But my hunch is we should be able to go from 15 to roughly 21-22% by 2030. That is the next 6 years. We are already seeing some parts of it starting to play out. If you look at the reasons why I am bullish about manufacturing, is that India is one of those very few countries where we have a very large working age population, and our per head salaries, wages is reasonable compared to all our competition. If you look around in across India, across the Southeast Asia or across the world, you will see that average monthly wages in the manufacturing sector is very, very competitive. So large manpower base at competitive wages is something which is very, very lucrative. Now you look at the projected exports that we've seen from different sectors, and these are numbers from management, right? It is not numbers that we are cooking up. The chemical sector is looking to improve exports, so is pharma, so is industrial machinery. Electrical and electronics is a huge that is the area where I think the biggest jump is going to come from. Automotive, textile, so all of these are very heavy manufacturing industries, and we are likely to see very long and sustained growth in each of these industries. Like I said, we are already seeing some part of it. If you look at iPhone manufacturing, that single-handedly has picked up the total overall mobile exports in India, from India. So that is a big thing. Already earlier this month, Apple announced that they will start making earbuds in India, their AirPods. So again, these will happen incrementally, and once it picks up, then suddenly you will find a deluge of MNCs coming and starting exports from India. Another case in point, Ford is talking about rebuying their or restarting their Tamil Nadu plant, and they are not really planning to start that plant to sell cars in India. Their objective is they will start that plant, build in India and export to Africa and Europe. That is at least their primary plan. So again, we are coming back to that point that India is a very, very lucrative manufacturing destination. The other is that if you look, both foreign and domestic investors are investing in India, right? Last 1-2 weeks, I think, because China announced quantitative easing, there were a lot of outflows of hot money from India, but I don't think that is a sustainable or that is a long-term phenomenon. I think India is going to attract very strong, very stable, long-term foreign capital, because the dynamics and the fundamentals of India today are probably superior to that of China at a macroeconomic level. So that is something that we need to be, we need to have that sense at the back of our minds. And lastly, I think I keep repeating this all the time, my 1-4 rule. Keep reminding yourself of this, every few months, and I'm sure I will keep reminding you of this, that whenever you are investing in equities, remember that in 4 years, you will lose money, right? 4 साल में एक बार पैसा खोना है. 1 in 4 stocks that we pick will not play out the way you thought it would, right? You will have thought that this company will do so and so and it will fail. 1 in 4 stocks, either you will be too early or too late. Now the point is that this is going to happen. Once every year you will see a 8-10% fall. Once every 2 to 3 years you will see a 20% fall. Once every 7, 8, 10 years you will see a 30 to 40% fall. Whenever you are in the market, keep reminding yourself of this. This is the nature of the market. There is not going to be any change. So always be prepared कि हाँ 10%, 15% market गिर सकता है. Do not put in money which you need in the next 1 year, 1.5 years, 2 years, because markets can go down at any time. So only invest money which you will not require for the next 3 years, 4 years, 5 years, 10 years. Equity markets are for wealth creation. It is not for income generation. Income generation के लिए you should go for bonds, FDs, real estate, rental income, etc. Equity markets can create wealth beyond your imagination, but it is not for wealth. It is not for income generation. So please keep that in mind at all time. We don't know when the next bumper year will come, right? It could be this year, it could be the next year, or the next year could be bad, right? So we do not know the sequence of events. वो 4 साल में 1 साल खराब कब आएगा वो हमको भी नहीं पता, आपको भी नहीं पता, किसी को नहीं पता. And the most rational thing to do is, if you have a long-term horizon, keep invested and keep investing. Ultimately, wealth creation is a function of the capital that you put in. So your savings rate is very important. How much money you can save and deploy in wealth creation opportunities, right? So ultimately, keep in mind that it is very important to remember that markets will go up and down, and the objective is to compound your capital at a reasonable rate over long periods of time. Thanks for listening. I hope if you have any questions, do send it to me at equity@shreerama.co.in. And I am planning to have a interaction with all of you through a webinar, probably sometime after, maybe before or after Diwali. Looking forward to interacting with you all. Thank you, and happy festive seasons once again.